Trump has announced that he'll be doubling steel and aluminum tariffs from 25% to 50%, further insulating domestic manufacturing and reducing competition for American steel producers. In this video, we're going to review what the effects of these tariffs will be and all the potential public companies we can invest in to benefit from higher steel prices in the United States. According to Trump, the tariffs are set to take effect on June 4th, so just a few days from now. Apparently, industry leaders approached him to say that the initial 25% tariffs on steel and aluminum were being circumvented, or they simply weren't strong enough. So that's why we see Trump doubling the tariffs now. In my last video, I covered how many of the Trump tariffs were being blocked by the U.S. Court of International Trade, but that did not apply to these tariffs because they're included under a different law. The Trump administration can still use Section 232 of the Trade Expansion Act, which is part of a different law than the one that the courts blocked. Stats from the U.S. Commerce Department tell us that steel already trades for a significant premium in the United States. Steel costs around $984 a metric ton here, $690 in Europe, and $392 per ton in China as of March. And steel prices have already increased approximately 16% since Trump assumed the presidency. Prices will rise even further given these increased tariff rates. So we can assume that steel producers will see higher profits over the next few years, assuming that Trump maintains these tariff rates. It's likely that we will see some retaliatory tariffs from countries like China, Canada, or the European Union. The EU has already announced its frustration with the announcement, and ironically it hurts the countries closest to us that are generally our allies, like Canada or Mexico, the most. Japan is also reasonably high on the list at 4% of total US steel imports. The hiked tariff announcement also seems to be in an effort to support the pending potential buyout of US Steel by Nippon Steel, which is the Japanese steel conglomerate. That buyout would be for approximately $15 billion, and Nippon would make an additional $14 billion investment to upgrade US Steel's manufacturing capabilities and iron ore mines. So that's why Trump is fighting for that deal so hard. Regardless of whether or not that deal goes through, the rising steel prices are going to hurt a variety of different industries, particularly construction, mechanical equipment manufacturing, automotive companies, which are already struggling as it is, and more. Any of the companies that operate in these sectors in the United States are going to see rising input costs as the price of steel continues to increase thanks to these tariffs. So it might be a good time to avoid these sectors if you're invested in them, or if you were looking at any companies in those areas. Overall, tariffs like this are estimated to contribute to broad inflation numbers and will obviously increase prices across different sectors. And that's why we should invest in companies that stand to benefit, like the steel manufacturers will. We're focusing on steel producers in this video rather than aluminum because the aluminum companies are actually being hurt by these tariffs to a certain extent. The raw materials used to smelt their aluminum are more expensive as those materials are largely imported from Canada and other nations. Meanwhile, these steel producers sourcing their raw materials from construction scrap or even some of the iron ore mines domestically can all be found within the United States. So steel manufacturers can reap the benefits better than the aluminum companies can. Ultimately, we could see these tariffs get rolled back by a new political administration in a few years, but things should go well for the steel manufacturers while Trump is in office. We will only be talking about companies producing steel themselves in this video, although some of the iron ore makers and metal recycling stocks should do well simultaneously if you're looking for even more stocks to research. We have 6 primary potential investment options we can choose from for stocks that produce steel domestically. The criteria we're going to focus on are that they predominantly operate in the United States. Most of the companies use electric arc furnaces or EAF technology to create steel, which tends to produce steel through using scrap metal instead of needing raw materials that would likely be sourced from other countries. If they don't use EAF, then they need domestic sources for iron ore or metallurgical coal. The stock needs to have significant vertical integration, meaning they have control over most of their supply chain and can source metal within the country. And their sales primarily need to occur in the United States, so they're not threatened by potential retaliatory tariffs if they are large metal exporters. The first stock on our list is Nucor, ticker NUE, which has a market cap of $27 billion. It's up 8% today, and this company is the largest steel producer and recycler in North America. So if you're looking for the safe and most diversified option, this would be it. They have 25 facilities, including 15 bar mills and others, producing a variety of different steel products, over 100 fabrication centers across North America, and their primary production method is the electric arc furnace, or EAF. So the company largely uses scrap metal, which will be good for avoiding the tariffs. So they seem like a good option if you want a large company, although they do have some operations outside the United States. Steel Dynamics is the second stock to consider, ticker STLD. They have a market cap of $19 billion, and the stock reacted quite well to the news. It was up 11% in after hours on Friday, and it's up another 9% today. STLD ranks as the third largest steel producer in the States and operates 6 EAF steel mills, all located domestically. They do have some operations in Mexico, but export sales only accounted for 6% of their net sales last year, so they're heavily insulated from hostile tariffs. This is another stock that only uses EAF technology, so the usage of domestic scrap metal means that they don't need to worry about any of the tariffs, and they only benefit. They also operate one of the nation's largest metal recyclers, OmniSource, so they're vertically integrated quite nicely and can ensure they have the cheap material they need to make steel. Cleveland Cliffs, ticker CLF, is the third stock to look into. It has a market cap of around $3 billion, and the stock exploded after hours on Friday, up 33% on the Trump news and another 20% today. They operate several large electric arc furnaces as well as blast furnaces, which are the ones that need those raw inputs like iron ore and coking coal instead of using recycled scrap metal. The difference for CLF specifically is that they operate 5 iron ore mines in Minnesota and Michigan, and the company was originally an iron ore mining firm before they acquired existing steel manufacturing assets. Additionally, they have coking coal operations as well, so they are largely vertically integrated to produce steel without worrying about the tariffs affecting their input products. Although it's somewhat unclear how much of their inputs need to be imported, if any, on the coal side, since metallurgical coal is required to create steel, so you might need to do more research into that, if possible. Commercial Metals Company, ticker CMC, is number 4 on the list with a market cap of $5 billion. It's up 6% today, and the stock operates 6 EAF mini mills and 3 EAF micro mills. Now, given the name, these mills are smaller, but also allow for more flexibility, so they can be shut down or turned back on with less complications than a large operation. They are vertically integrated into the scrap metal recycling business with 43 facilities. Around 10% of the company's sales are from European operations, so 90% of its business is in North America, primarily in the United States. The United States Steel Corp, aka US Steel, is number 5 on the list, ticker X. They have a market cap of $12 billion. The company is slightly different because they have significant operations in the United States with both blast furnace and electric arc furnace steel mills. They also have significant operations in Europe as well. So those European operations could be hurt negatively depending on where that steel ended up. As far as the blast furnaces go, US Steel does have iron ore mines in Minnesota, but they likely do not have a domestic source of coking coal, and that would be a negative as tariffs will likely impact prices there. And as previously mentioned, this company is also on the brink of potentially being bought out by Nippon Steel, so there might not be much upside left for this stock. Probably one of the worst options, but it's worth mentioning. And lastly, we have Metallus, ticker MTUS. This is the smallest company of the bunch with a market cap of $530 million. It's up 6% today because of the tariff news. The company owns several EAF mills in Ohio and has a manufacturing location in North Carolina. With sales outside the U.S. making up just 12% of their revenue mix, the company is nicely insulated from harmful tariffs. On the flip side, Metallus is a special manufacturer of specific steel products that require specialty alloys like chromium or vanadium to be produced, and it's unclear how much of that product they need to source outside of the States. So that could be a potential issue if prices got out of hand there. Metallus is likely a decent option, but could be subject to negative pricing trends depending on how things play out with some of the raw materials they need. So while all these stocks are decent contenders, if you want the stocks that are most likely to reap the benefits from these higher tariffs while facing minimal or no downsides, you're looking at Nucor, Steel Dynamics, or Cleveland Cliffs. These firms mostly or entirely operate EAF furnaces, have vertical integration with scrap steel processing divisions, or have clear sources for most of the raw materials they need to produce steel domestically. We also have to remember that more than 70% of these steel furnaces in the United States are EAF at this point. So the more that trend continues, the tighter the domestic scrap steel market could get. Just something to keep in mind that prices could potentially rise there as well. But do not consider any of this investment advice. I'm not saying that I bought or sold any of these stocks. Always do your own due diligence. My videos are just meant to point out potential investment opportunities for you to research further on your own. With that said, if you'd like to stay up to date about these significant market-moving events like this, and learn about different potential investment options to take advantage of them, then subscribe to this YouTube channel and check out my Substack. Links in the description. Thanks for watching.